End of the day, 1% in the green, and mostly buoyed by the fact that commodity prices are higher. I mean, we saw the likes of Anglo Platts up 3.3% and Exara again of 3%. But on the other end, we also saw some resource companies coming under pressure. African Rainbow Minerals down 2.2%. ArcelorMittal a loss of 0.3%. Does any of the losses that we've seen coming through on the commodity front, the resource picture, of course, got to do with a very strong rand?
Yes, I guess the rand was very strong today, sort of strengthening all the way to about 7.28. So I would have thought the resource counters would have been maybe a bit weaker. Having said that, you did see platinum and some of the other metals hit very high prices yesterday at their close. But I think there's also been quite a lot of trade in terms of the derivatives trade with futures close out tomorrow that may be distorting some of the prices today and perhaps going into tomorrow as well.
Well, looking at the retail front as well, I mean, we saw Steinhoff up 3.7%, and of course, keeping in mind we had better than expected retail sales numbers out as well. Are you feeling confident that the retail sector can go higher from these levels, given that most stocks have, of course, rallied quite significantly over the last year?
Correct. I mean, Steinhoff is more of a play on the UK furniture market, so I don't necessarily think that our retail sales would have affected that stock too much. But our general view is that the retailers have had a very strong run and are pricing in more than sort of a strong recovery. So we think they look quite expensive at these levels.
Okay, right. Joining us now as well is Chris Hart from Investment Solutions. Chris, your view on the retail sector at the stage, and of course Johnny does say that Steinhoff up almost 4% in fact, but it's mostly exposed to what we've been seeing in the UK rather than here in South Africa.
Although they're also at the cusp of a recovery, and I think the retail sales really reflect that we are at a cusp of recovery, but still a mixed bag. Your retailers for instance, in furniture, for instance, still struggling, still in recession there, whereas you've got a broader spread where your clothing retailers are starting to come back after really having very difficult trading conditions in the last year or so. They're starting to come back, and I think the market's already anticipating the US story and interest rates. The same here. I think we're looking at interest rates staying where they are for a much longer period, which I think will allow the consumer spend to build up and start to accelerate through the year. And that means although the retailing sector might look a bit overcooked, it might be more overcooked by the time we get to the end of the year.
All right, looking at the very strong rand, some say that is overcooked. I mean, it's sitting at around 7.29 to the dollar. What is that about? We know that Moody's said that they're keeping South Africa's credit rating at stable at this stage, and we know sovereign ratings also under the spotlight globally. Does it have to do with flows, or is it about sentiment?
The rand is about the stock market at the moment. In other words, usually we say, is it connected with emerging markets or commodities or whatever? In a sense, it is connected with commodities, but effectively, as the stock markets are starting to run, the S&P setting a new 12-month high, for instance, you'll see that the rand also is following that, and that's because foreigners are buying our resources shares, and our resources shares are also doing well despite the strength of the rand. And we need to realize that that's a mechanism. It was confirmed when the market pulled back that the rand weakened and resources shares also weakened at the same time, and now we're seeing the reverse.
Johnny, you mentioned the derivative market, which we know has been under the spotlight globally. Of course, keeping in mind the derivative market is worth $600 trillion, which is 12 times the world's economy. We also had Prime Minister Gordon Brown winning a delay on any kind of regulatory reforms in the derivative market. And we're also hearing that perhaps we could see more transparency, more regulation by moving derivatives from over-the-counter into more controlled exchanges. Do you think that is likely to happen?
I guess there's vested interest in keeping the status quo. So I guess the UK does depend on their financial centre being London. So with an election coming up, I'm sure Gordon Brown still wants to try and maintain the preeminence of London. So he's probably not going to want to damage that by bringing in more sort of transparency just yet for the derivatives market. But I think longer term there has to be a bit more transparency, particularly in markets like the credit default swap market, where there's quite a lot of over-the-counter trade. which does expose the global financial system to certain counterparty risks that need to be eliminated long term.
Okay, we know that the UK holds 80% of Europe's derivative markets and 60% of the private equity market. If we do see changes, significant changes in these markets, what does it mean for the UK?
The UK, like I said, depends quite a lot on financial services. So a lot of their tax revenues come from that base, and the UK, like many European countries, are suffering from bulging budget deficits. So they need companies to generate profits to pay their taxes to pay back those deficits. If they lose that human capital to places like Singapore, and already we've seen the likes of HSBC move their head office back to the east, they will lose tax revenue and global competitiveness, and they will struggle to pay back those deficits.
Chris, do you think that hedge funds derivatives pose a systemic risk to the global economy?
I think certainly where there's an opaqueness, where you've got effectively a nominal exposure of 600 trillion, which is multiples of the global economy, there's problems. I think there's also a problem when you get over-concentration of certain players in this particular market. It does mean that you can use this to manipulate markets, and that I think is pervasive. And if the manipulative element of markets can actually be taken away, derivatives can be useful instruments, but unfortunately you've got derivative usage way beyond any underlying assets, etc. There certainly does need to be greater scrutiny, but the vested interests of New York and London dominate this market, and Gordon Brown already is indicating that we don't, hands off here rather, and it means we just carry on as we were. So the systemic risk continues.
Johny, let's turn our attention now to the FOMC meeting, and interest rates in the US will be kept near zero for an extended period of time, but there was a little bit of a surprise in that meeting, and they're basically pulling away stimulus from the housing market, which is expected to end by the end of March. Could you read anything into this? I mean, do you think that this could perhaps signal that we are closer to an interest rate hike in the US than we think?
Well, they still used the same phrase, extended period of time, and I think there was only one dissenter among the FOMC who dissented on the view that he didn't want the term extended period to be used. In terms of the support to the housing market, I mean, it still continues in a number of guises. The one that looks to be ending in March, I think if you bear in mind, was originally meant to end last November, and they've extended it till March now. So although they are removing it, the original deadline has been extended somewhat, and there are a large number of other supports in the market for US housing.
Johny, you mentioned futures close out tomorrow. How are you playing the markets ahead of the closeout? Anything in specific that people should be doing out there?
Look, at Element we take a long-term view, so sort of futures closeout shouldn't really impact us at all tomorrow. So yeah, it's almost a non-event for us tomorrow.
Chris, what would you be doing at this stage of the game, given that some people are expecting a little bit of a correction coming through? You've got a very strong rand, and people are just looking at some of the positive economic data, but on the other hand, there's a lot of global influences at play as well.
Exactly. I think we've got to be careful. I think there might be some momentum building in the market. Again, it's a zero interest rate push to the markets. So I think, again, I would agree that the closeout tomorrow will prove to be a mere speed bump at the end of the day, but there is volatility always associated with that closeout.
Johny, we also had results out today from Avenge. They're sitting on 3 billion rand in cash. They've retrenched 500 workers, and we know that there's also been project cancellations, which was only limited to around 200 million rand. Construction sector under the spotlight, given that the 2010 Soccer World Cup infrastructure spend is basically coming to an end. Your prospects for a company such as this one?
Yes, on Avenge, they're actually sitting on a bit more cash. They're probably sitting on about 7 billion of cash. The 3 billion that you mentioned is sort of unencumbered cash. So Avenge is one of the stocks in the construction sector that we like, mainly because of a reasonably good pipeline. The order book actually grew over the period, and also because of the strong cash underpin, which will either be used to be returned to shareholders via more dividends, or perhaps be used by them to bolster their presence either in the water treatment or the nuclear space.